Taxation is one of the easiest scoring units, yet many students lose marks by mixing up key concepts in the exam. In this video, I'll show you a simple way to understand and remember the entire Unit 5. Let's get started. This is the Part 5 of International Finance playlist. Unit 5. Taxation in International Finance 1. Define taxation and explain various types of taxes. Taxation is the process by which government imposes compulsory financial charges on individuals and businesses to generate revenue for public expenditure. Types include income tax on earnings of individuals and companies, withholding tax deducted at source before payment, value-added tax charged at each stage of production with final burden on consumer, Tobin tax on foreign exchange transactions to reduce currency speculation, other national taxes like customs duty, excise duty, corporate tax and property tax. 5 types. Remember them as direct taxes, income and withholding, indirect taxes VAT, international tax Tobin and other taxes. That grouping covers all types in a structured way. Now Q2. International tax methods are very practical. 2. Explain various methods of taxes in international tax environment. International taxation uses 4 main methods. Worldwide approach taxes global income of residents regardless of where it is earned. Territorial approach taxes only income earned within the country's geographical boundaries, exempting foreign income. Tax deferral allows postponement of taxes on foreign profits until repatriated to home country, improving cash flow. Foreign tax credit allows taxes paid abroad to be deducted from domestic tax liability, preventing double taxation. Worldwide versus territorial is the most important contrast here. Learn that distinction clearly. Foreign tax credit is the solution to double taxation, which is another frequent exam point. Now Q3. Tax implications of foreign enterprises is India specific. 3. Define and explain tax implications of foreign enterprises in India. Foreign enterprises earning income in India are liable under Income Tax Act 1961. Key implications include income tax on business operations, services and capital gains in India. Permanent establishment rule making profits from Indian offices taxable. Withholding tax on interest, royalties and technical fees paid to foreign firms. DTAA, agreements with multiple countries to avoid double taxation. GST registration for supply of goods or services within India. Transfer pricing rules for transactions with Indian subsidiaries. Capital gains tax on asset transfers. DTAA and permanent establishment are the 2 concepts examiners focus most. Define both clearly in your answer. Now Q4, transfer pricing methods are practical and frequently asked. 4. Define transfer pricing and explain its methods. Transfer pricing refers to pricing of goods, services or financial transactions between related units of the same multinational company across countries for proper profit allocation and fair taxation. Methods include cost-based price, adding profit markup to production cost, market-based price following arm's length market prices, negotiated price mutually agreed between buying and selling divisions, administered price fixed by top management or government, dual price using separate prices for buyer and seller divisions. Other methods include marginal cost and profit sharing methods. Arm's length principle is the core concept behind transfer pricing. Always mention it. Examiners specifically check if students understand why transfer pricing rules exist to prevent tax avoidance. Now Q5. Tax planning areas are straightforward scoring points. 5. What is tax planning? Explain areas of concern of tax planning of multinational enterprise. Tax planning is the process of analyzing financial activities to minimize tax liability legally using available deductions, exemptions, and incentives. Areas of concern for MNEs include expansion into new markets, choosing tax-friendly locations, diversification across sectors evaluating tax implications, location of business in low-tax countries, capital structure decisions using debt for tax-deductible interest benefits, R&D investments for tax incentives, choosing form of organization for better tax treatment, amalgamation of SIC units for loss carry-forward benefits, source of finance selection for minimal tax cost. Tax planning is legal tax minimization. Never confuse it with tax evasion, which is illegal. That distinction in your opening line always impresses the examiner. And that completes Unit 5 clearly. And here, we work hard to make your learning simple, clear, and completely free. Please support our channel, because no one else is taking this much effort to create free PDFs, notes, and study materials for you. Our only goal is that every student should pass, even if you don't have proper materials or guidance. And one best suggestion, take a printout of our PDFs and study from them. I guarantee you, not only will you pass, but you can score high marks with confidence. Your comments and likes are our biggest motivation to create more free PDFs and study materials for you. And please share this video or playlist in your college groups and friends. They will also benefit it. All the best for your exams. Stay focused and stay final focused.